Let's look at this example in which I will be using options to value a license agreement. So example follows. Toy company called Shippuden made a license agreement with the video games company called Suga. The license would allow Shippuden to produce the toys, including figures and playsets of the IP intellectual property owned by Suga for the next 10 years. Shippuden will produce and market the toys. Financial analysts of Shippuden completed the DCF analysis, and it was estimated that future cash flows for this licensing project would amount to $6.7 billion. It is also estimated that current cost of developing the products and starting production will be around $7.2 billion. This is a new project for Shippuden and it hasn't been involved in such projects before. So its analysts adjusted the risk of the project accordingly, and the standard deviation of returns on such projects is estimated conservatively at 53%. Should Shippuden collaborate with Suga immediately on this licensing project? How valuable will this project be if Shippuden has the option to delay the development and the production? What would have been the right action for Shippuden if the development and production of the toy had cost $6 billion instead of 7.2 billion originally? Should Shippuden develop and start production in this case? So let's look at the solution. If you look at this example, you will see that this is a real option and Shippuden has the option to delay. The value of the call is the project's real value with the option to delay. The sole net present value analysis ignores the option to delay, and in the first scenario, the net present value is negative. So if you had decided on using the sole net present value analysis, you would have reached a wrong conclusion. Also, one input value is missing and it is the risk-free rate. You need to use the yield on a 10-year treasury which matches the duration of the project. So in this example, S, the value of the underlying asset, is the present value of future cash flows from developing, producing, and subsequently selling the product within a time frame of 10 years. The present value of future cash inflows as was estimated through the DCF analysis. An X strike price cost of developing and producing the toys according to the license agreement should put and holds the call option, also featuring the option to delay. And sigma volatility, standard deviation of the returns on similar projects or companies. You can also use standard deviations of returns on publicly traded stocks that have similar profile to that of the company you investigate. And T time to expiration, complete life of the license agreement from development and production to selling, and R risk-free rate, and B dividend yield, cost of delay. We will use this in the second scenario of the question in which net present value is positive. For example, the cost of delay might cause lower profits due to less time related to all activities, including development, production, and sales. So it should actually reduce the value of the call as it must be in reality. Because of this effect, it is practical to define it as a function of time to expression. Example, you want 1 over t. So for the risk-free rate, 10-year note, the yield is 4.139%. So we will be using this risk-free rate in our Black-Scholes option pricing model, and this value is as of 1st of April 2025. So you need to enter the input values as was shared in the question prompt. For the risk-free rate, again, you need to enter 4.139% shared on the previous slide. If you were to use net present value analysis, you shouldn't start this project because remember, the initial cost was $7.2 billion. So this will be a cash outflow. This is your investment, and the present value of your future cash flows will be $6.7 billion. So based on the net present value analysis, the value of the project is minus $500 million. So it's a negative net present value project. And recall that on slide 192, I showed the adjustments that needed to be made in the Black-Scholes model if there were dividends. So the dividends will be used here in terms of cost of delay. And subsequently on slides 193 and 196, I showed you my Excel spreadsheet, this one. This model contains these adjusted formulas. I will use the same spreadsheet model to solve this example. So I just entered the input values here. The stock price, the value of the underlying asset, will be the present value of future cash flows at $6.7 billion. Strike price will be the cost of development, cost of starting this project and producing and selling at $7.2 billion. And volatility of the project is 53%. Remember, risk-free rate is 4.139%. Time to expiration T in years will be 10 years, and dividend yield in the first scenario will be 0. And then you will get this call price based on these D1, D2, and D1 and D2 values. Remember, actually, the value of the project uh, will be equal to the call price, because as you will see, if your future cash flows actually have a sizable value, you can actually start this project by paying this $7.2 billion. Even if initially the call option is out of the money, as is the case, as we also uh, reach reached by using net present value analysis, the same result. We have very high volatility and very long time to expiration. So because of these two values, this project might be valuable in the future. So Black-Scholes model estimates the call value accepting the project with an option to delay as $4.45 billion. So this project is still valuable even if undertaking it now is a negative net present value project. So Shippuden should enter this agreement with Suga with this option to delay. It shouldn't scrap the project entirely just by looking at the current negative net present value analysis. However, it shouldn't start immediately either. The license agreement is still valuable with the option to delay. Because of this high volatility, 53% may result in higher future cash inflows, so that the option, that is the licensing project, will be more deep in the money and will be more valuable because of this. Also, because of the longer time to expiration, which may also increase the upside potential of the project, in addition to the positive effect of the high volatility. So alternatively, selling the patent to someone else rather than developing the patent may be also more financially rewarding. So in the second scenario, the costs drop to $6 billion, which is the exercise price of the call in our model. So you need to change this. Now the call is in the money, because remember, this stock price will be the same, the present value of your future cash flows. The cost has dropped, the strike price. So now the call is in the money and the net present value is positive at $700 million. Should she put and start development and production immediately? Here we can define an expected cost of delay, 1 over 10. Remember, time to expiration was 10, so that's why I used 1 over 10, 10%, because the net present value is positive. Now, there should be some costs related to delaying, and this can be reflected through the dividend yield component of the model. Recall that a high dividend yield will reduce the price of the call. So if you, for example, postpone the project only for 1 year, you will be losing 10% of your uh, future cash flows. For example, for 2 years, you will be using 20%, because each year you will be losing 10% of each year you are delaying the project, you will be using 10% of all future cash inflows. So based on these input values, the call price is around $1.23 billion, and it is still more valuable to delay the project because this value, 1.23 billion, is greater than $700 million. So even if costs have dropped to $6 billion and net present value has been positive, Shippuden should still wait and delay the project. Again, because of the high volatility at 53%, the upside potential may render future cash inflows higher. So way higher than this $6.7 billion initially. And the project might be more valuable in the future than it is now. Importantly, to see the effect of time to expiration, which is too long for this project at 10 years, and the volatility, which is again too much at 53%, you can reduce these two input values to smaller values and observe how they will impact the price of the call. So I decreased the volatility value to only 1%. Remember, initially it was 53%, and time to expiration to just 0.5 years, actually, um, 6 months. And remember, initially it was 10 years. So now look at the price of the call, it is zero. So call is very deep out of the money. And in this scenario, net present value analysis results in the same decision as that, which would be reached through using option pricing. So the option to delay this project is also worthless at $0, while the net present value is negative at minus $500 here. This is your cost. This is your future present value of your future cash flows. So at minus $500 million. So we reach the same conclusion in this case. But however, a longer time to expiration, 10 years in the original case, and a higher volatility, 53% in the original case, make this project more valuable as was seen in the original scenario. But when we reduce all these important input values of the Black-Scholes model, volatility to only to 1% and time to expiration only to 6 months, of course the call price will be also zero, and the call will be worthless. And because also the net present value analysis result in a negative value, so you will reach the same conclusion. But here be careful of getting duped into thinking that Black-Scholes option pricing renders a negative net present value project a positive one. This is not the case. What Black-Scholes really does is to factor in the volatility, that is the risk of the project, which is 53% for the original case, for example, it was very high, and time to expiration, which is 10 years again in the original case, and it's also long duration, both of which will be ignored by the net present value analysis. So Black-Scholes actually considers these two input values, something net present value and analysis couldn't done. So in light of these two important variables, the project might be valuable if you recognized and took the risk accordingly.